The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. If you're new, I'm your host, Dan Sipe. Additionally, the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. I'm going to begin, as I always do, by saying thank you. Thank you for taking the time to listen, but above all, thank you for your service to the government, to the country, to me, to everyone. You absolutely do not hear that enough, but you will always hear it here. The other person you always hear here is Ed Zerndorfer. Yes, the guru is back with us as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. So once again, we're going to follow Ed's FedZone articles, which you can find at fed-zone.com. It gives us one more way to reach and teach. So today, Ed is tackling a topic that's close to his heart and that catches a lot of federal employees and retirees off guard, and that is estimated tax payments. Uncle Sam wants the money as you earn it, and if you're not having enough withheld, you could be looking at penalties. So Ed has laid out everything you need to know. So Ed, let's start with the big picture. Most federal employers are used to having their taxes automatically withheld from their paycheck. Why would a federal employee or retiree ever need to make estimated tax payments on their own?
Well, then, as you said, the IRS likes to get paid as individuals earn their income. Now, that in terms of earning income, we're including wages, salary. It could be investment income. Somebody invests in the stock market. Somebody puts money in a bank and gets interest, and they have to pay taxes on the dividends they get in the stock market or capital gains they incur when they sell stocks with capital gains, interest they earn in the bank. And salaries, when one has a salary, as you said, their taxes are withheld. Federal and state income taxes are withheld. And the employer is obligated to collect the taxes, pay it to the IRS on a quarterly basis, some cases on a monthly basis, in order for the IRS to get the money that's due to them. When I'm saying that is because the government has a cash flow problem. They have bills to pay and they need income to pay, coming in to pay those bills. Now, I just want to point out that the federal income tax, individual income tax, started in 1916. And for the first 27 years until 1943, there was no withholding. What happened in 1943? World War II, big defense budget. And at that point, the government decided, let's start withholding federal income taxes from an individual's wages. That's when it first started. Now, as you said, there is withholding on federal income taxes, but the problem is that individuals have income that is not subject to withholding. I mentioned a few of them: stock market, income coming in from the stock market, dividends. Somebody sells a stock that has gone up in value, has long-term capital gains. Here's one that many people may not be aware of, that when you convert a traditional IRA to a Roth IRA, you have taxes to pay, and there is no withholding whatsoever. Or more recently, the traditional TSP, if someone has a traditional TSP account, they can convert it to the Roth TSP. Once again, the TSP will not withhold any federal income taxes. So where is the taxes going to be paid that are due on those conversions on that income? Answer: through quarterly estimated tax payments. That's
Gotcha.
That's what the IRS expects individuals to do if they know they are incurring income that is not subject to withholding. Quarterly estimated tax payments.
Gotcha. Now, Ed, one of the things in your article just blew me away. And that, as you mentioned, the tax penalties have surged over the last 2 years for filers earning between 200 and 500,000. The penalties totaled 1.3 billion in 2024, and you say that's triple the amount from 2023. Why are so many people getting hit with these penalties now?
Part of the reason is that when they file their income taxes come spring, they have huge balances due. When I say huge balances, if someone owes more than $1,000 in federal income tax when they file their income taxes, they could be subject to what's called an under withholding penalty. That's $1,000. And not only will they have to pay this penalty, but they have to pay interest. Now, one of the reasons that the amount of the penalties have gone up so much since 2023 is that interest rates since 2022 have been much higher than they were before 2022. So that has resulted also in larger amounts of penalty. Some of the reasons that people are owing so much money is that, one reason, the stock market. The stock market has done very well over the past couple of years, not taking into account some of the ups and downs here and there. But let's face it, the stock market since COVID has been on a tear. Dow 50,000. Who thought about Dow 50,000? I remember when the Dow hit 1,000, people were screaming. That's how old I am. Anyhow, that's one possible reason. And as a result of the increase in the stock market, people have sold stocks, bonds, you name it, all types of investments at gains. They were not aware of the fact that they had to pay tax on those gains, not at the end, but not when they file their taxes, but throughout the year, in particularly in the quarter that they incurred those gains or it received that large amount of income, interest income, whatever, investment income. Another reason is there's been so much talk about the traditional IRAs being converted to Roth IRAs. Ever since the Tax Cuts and Jobs Act of 2018, when tax rates were lowered, the big push has been to convert from a traditional IRA to a Roth IRA for a variety of reasons. We're not going to get into that now. And individuals were not aware, gee, that's a great idea. I think I'll pay my tax. I'll convert my traditional IRA to my Roth IRA. Tax rates are low right now, but they're going to go up. So it's a great idea. Let's convert right now. But they weren't aware of the fact that they had to pay the taxes on that conversion in the quarter that they made that conversion. And that has caused a lot of, under withholding penalties.
Gotcha.
People owe more than $1,000 when they file their taxes.
Gotcha. And here's the thing, Ed. I know this because of having a business. A lot of folks don't. I think most people think of quarters as January, February, March, April, May, June, July, August, September, October, November, December. Can you walk us through the 2026 due dates? Because they're not true calendar quarters, are they?
That is correct. There are 4 quarters. IRS has 4 quarters. The first quarter runs from January 1st to March 31st. All right. When is the due date for estimated taxes? That is, taxes have to be paid on any significant income received during any time between January 1st and March 31st, April 15th. April 15th. The second quarter of the year starts April 1st, ends on May 31st. May 31st. And any federal estimated taxes that are due, that have to be paid, are due June 15th. Then the third quarter encompasses the summer, June 1st to August 31st. I guess the IRS doesn't want to bother people during the summer paying estimated taxes, but the third quarter does run from June 1st to August 31st. Any estimated taxes that have to be paid for the third quarter, that's the third quarter, are due September 15th. And finally, the last quarter of the year starts September 1st and ends December 31st. That's the fourth quarter. And any estimated tax payments that are due for the fourth quarter are due January 15th of the following year. Now, I will tell you, people say, gee, that's strange. You have to pay your taxes in the fourth quarter. The estimated tax payments are due January 15th. Why did they do that? Well, it is the last quarter of the year from September 1st to December 31st. If IRS said, well, your estimated tax payments have to be due December 31st, that wouldn't give people time to figure out what they really owe. So they give them 2 more weeks, January 50. And it's a little confusing. I have clients, and Dan, I've been accounting and tax practices. I made my 4th estimated tax payment, like this past year, for 2025. I made it on January the 8th, 2026. So I can put that on my 2026 taxes. No, it is for calendar year 2025. They get a little confused.
Sure. And Ed, as you always do, you always have fantastic examples. So you give us a great example in the article about a federal employee who converts $10,000 from their traditional TSP to Roth TSP, because you can do that now, folks, but then waits until December to pay tax on that conversion. So what happens?
Yeah, let's run through the example. All right, so the employee converted a traditional TSP account, $10,000 of their traditional TSP to the Roth TSP. Did it in February 2026. Now, since the employee made that conversion of traditional TSP to Roth TSP in February 2026, that's the first quarter. Turns out they're at a 24% federal marginal tax record. So how much tax do they owe? 24% of $10,000, which is $2,400. Keep in mind, Dan, TSP does not withhold any federal taxes. And people say to me, well, wait a minute. I took $10,000 out of my traditional TSP and they withheld 24% or $24,000. They took out I requested 24%. And he took it out. Okay. So what's the difference here? Well, that's a withdrawal. That's fully taxable. Yeah. And the TSP is doing you a favor by withholding 24% taxes. This way, when you file your taxes, you'll have something to show for it. It's like withholding from your salary. Why not do the withholding on the conversion of traditional TSP to Roth TSP? Why does the TSP withhold, in this case, $24,000 from the conversion of the 10,000 traditional TSP to convert it to the Roth TSP? And the answer is, Dan, if they did, you would only be converting what? $7,600. You don't want that. You want the full $10,000 to go to Roth TSP. So whose responsibility is it to pay the $24,000? The TSP participant. How do they do that? They pay estimated taxes. When would that estimated tax payment be due for this case? April 15th.
Surprise.
April 15th, the deadline for making your first quarter estimated tax payment. But the person wasn't aware of this. They waited till December. They made the estimated tax payment until December. They figured they'll get it in before the end of the year. Well, how late are they? Only about 8 months, April through December. IRS is going to impose a penalty. And the person says, why? Because the IRS wants the money now. They don't want to wait 8 months. Think about the $10,000. What can you do with $10,000? You put it in the bank, and okay, it's not a long 8 months is not a time. Maybe you get 1%, 2%, whatever it is, but it's still going to be income. The IRS says the government needs the money for various reasons. Federal employee says to me, for what? I said, to pay you. That's what they're using the money for. You don't want them to hold it. You don't want to hold it like that because eventually it'll come back to you. Anyhow, that's how these penalties occur because you were late paying the estimated tax payment. You were late by April through December. What is that? That's about 8 months. Yeah, 8 months.
Yep.
You're going to have an under withholding penalty for those 8 months.
Now, Ed, let's talk about the interest rate itself. What is the IRS currently charging on these quarterly underpayments, and has that changed recently?
Yeah, it's pretty stiff. It's effective April 1st, 2026. The interest rate is 6% on under withholding.
Wow.
It was last year 7%. So until now it was 7%. It was lowered to 6% because there's been a slight drop of the interest rates. I fully expect it'll continue at 6% come June 1st because interest rates had not fluctuated that much. That would be for the third quarter.
Sure. Now, Ed, you also, in your article, walk us through a step-by-step process for figuring out how much to pay and how to do it. Can you take our listeners through those steps? And let's use your example of the $21,500 total figure.
Sure. The following steps I recommend that one takes to calculate your estimated tax payments. And if one is totally overwhelmed and so on, please talk to a tax professional. Please
Sure.
talk to a tax professional. Sometimes it gets to be a little overwhelming, very tricky. And that's why I recommend you go to a tax professional who is fully familiar with these calculation of estimated tax payments. Okay. And here is the procedure or some of what one should do. The starting point, the step one is go to your 2025 completed income taxes. We're assuming you've completed your 2025 income taxes, Form 1040. The filing deadline is, you met the filing deadline, you submitted your return. So go to your completed return, and particularly this is Form 1040. Go to line 24 of Form 1040, and that line says total tax. So I'm going to use as my example someone whose total tax for 2025 was $21,500. $21,500. So you subtract from the amount in step one, in what I just mentioned, the 21,000. You subtract from the 21,000 the amount that the employee or retiree, because we're talking both here, the employee or retiree, expects to have withheld from wages, their salary if they're still working, if they're getting a CSRS or FERS annuity, they have federal taxes withheld from their annuities. If they're getting TSP, federal income taxes withheld. If you're getting Social Security, and if you have elected to have federal income tax withheld from your Social Security monthly payment, I know I am, okay, you would include that, okay? So let's suppose this individual whose tax liability, total tax liability, is $21,500, has a total of $18,500 in withholding during the year 2026, during 2026, okay? You subtract from that amount, from the $21,500 to $18,500, and that leaves you $3,000. $21,500 less $18,500 is $3,000. So the $3,000 is the gap between the $21,500 tax liability you had for 2025 and your expected withholding for 2026. And you're saying, why are you using 2025? 2025, your tax liability. And here's the answer. What I am trying to do here is to recommend that individuals work on what's called a safe harbor to avoid any type of underwithholding penalty. The IRS has two ways that you can avoid the penalty. It's called a safe harbor. And the first safe harbor is, there's two of them. The first safe harbor is if you match your total tax liability for 2025. This is the previous year because you're working on the current year as far as estimated tax payments. If you have withheld and you pay estimated taxes in total, it matches exactly your total tax liability for the previous year. There's not going to be any withholding penalty. It's called a safe harbor. You'll avoid the penalty. So my example here, $21,500 less $18,500 equals $3,000. Since you're paying quarterly estimated tax payments, divide 3,000 by 4, $750. That's the amount of your estimated tax payments for 2026, $750. And that will result in your meeting the safe harbor. Now, I want to clear up a misunderstanding. And I've had this discussion with many clients, and I've even told some fellow accountants about this. Dan, that 100% safe harbor means that, yes, you met the safe harbor for the year, in this case, 2026. But IRS has another rule. The safe harbor applies to each quarter of the year. It's not just for the entire year. It's for each quarter of the year. Because if that's $750 that you're paying each quarter in 2026 is not enough that fills the gap in the 2025 year. In other words, each quarter of 2025, you have to have the $750 together with your withholding has to meet the liability, tax liability for the quarter in 2025. It's a little tricky. So it may have to be redone. You have to redo this. You wouldn't have to redo this to make sure that you look at your 2025 tax liability for each quarter of the year, what it was, and then minus your withholding, and that will determine how much you have to pay each quarter. And that definitely will avoid any type of penalty.
Gotcha. Now, you also caution folks that the safe harbor threshold is different for higher income individuals. So, for example, folks who make over $150,000. Can you explain that?
Yeah. The 100% tax liability, if you're born, it will go up to 110% of your tax liability if your adjusted gross income during 2025 was over $150,000. Then you got to take 110%. So my example here, let me get my calculator. If their adjusted gross income in 2025 was let's say $170,000. So I'm going to take $21,500, their total tax, multiply that times 110%, and I come up with $23,650, 23650. It's 100%. That would be the safe harbor.
Gotcha. Gotcha. So, Ed, as our feds are listening to this, do our federal employees, retirees, if they'd rather not deal with making separate quarterly payments to the IRS, are there ways they can handle this through withholding adjustments?
Yeah, there is. And I'm going to relate a true story. I have a client, I did her taxes. And she has a huge RMD from her IRA. And she just became recently widowed last year. And she inherited her husband's tremendous traditional IRA, and she has a nice IRA too. So her RMD is quite substantial. So last year, when she took her RMD, she had federal and Maryland taxes withheld. Maryland has the same rules regarding estimated tax payments. It's very similar. So it turned out she didn't have enough withheld. She did not have enough withheld from her federal and state tax. She owed quite a lot on federal, and she owed quite a lot on Maryland. And I pointed that out to her. When I did her taxes, I put her on estimated tax payments. And she was a little shocked. I said, what does it mean? She was getting nervous what that all meant, these quarterly payments, something like that. Federal and state. So we talked. She said, is there any way I can get around this problem of paying the estimated tax payments? I said, well, yeah, there is. You need to have more federal income tax withheld from your R&D this year, because she has another big R&D coming up this year, and more Maryland tax. And she said to me, whatever the amount necessary, please do so. I said to her, well, you're in a 24% tax bracket, federal, and I'm going to use 9% state for Maryland. So she said, my R&D, to round numbers, is about $30,000. $30,000 is my R&D this year. So I said, tell your IRA custodian, take out in federal tax 24%, that's her marginal bracket, of 30,000 is 12,000. 24% of 30,000 is 12,000. And 9% of 30,000 is what? $2,700. That's Maryland tax withheld. And that should do it. She said, I know my IRA custodian will do that. Thank you for that help. I said, we're not done yet, though. We still have something to do. I have to ask you, when do you take your RMD? She said to me, usually in the fall. I want to wait as long as possible. I said, well, you can't do that because that withholding is coming out. That's coming later in the year. Once again, IRS wants to get the money sooner than later. Instead of taking your R&D in the fall, take it now in April or May. Okay? This way, you get your R&D, the money's coming out, the IRS will get it, and Maryland will get their money sooner than later. You definitely will not be subject to an under-withholding penalty.
Gotcha.
And she talked to our IRA custodian, boom. She said, it can be done. I said, please have your IRA custodian call me. We can work it out. Any questions? She said, absolutely. Perfect solution to the problem.
Yep, great tip. One more thing on this. You mentioned in the article that 25% of 2026 is already behind us. So some folks may need to make adjustments quickly. What's your practical advice for someone who's hearing this right now and realizing, ooh, I might be behind on my estimated taxes?
Yes. So if they're still working, they're withholding. They get paid every 2 weeks. If they're a federal employee, every 2 weeks. But as you said, Dan, they can increase their withholding. They could talk to their payroll office. But here's the problem. We're 25% through the year. So they're going to have to increase their withholding another 25% in addition to what they were thinking about doing. They got to add another 25% to that because they've already had 25% less withheld than they should have because of the three months that have passed. So you got to think ahead. Or they can do the estimated tax payments if they don't want to do that. Okay. IRS has a very good publication. It's IRS publication. Just go to the IRS website and put on under publications form 1040-ES. I have a link in my article on where to go to get that publication. It's called the form 1040-ES, or estimated statement package, and then all the information will be there. It's pretty comprehensive.
Gotcha. And folks, I didn't mention it earlier. I'll mention it now. Be sure to head over to the FedZone, fed-zone.com, and grab Ed's article and read through it. Because if you've been listening to this feverishly taking notes, that article has already taken the notes for you. So great examples in there, so you don't want to miss that. Ed, brother, you did it again. You take something that's intimidating like IRS penalties and quarterly tax schedules, and you make it completely understandable. Our feds and retirees are really lucky to have you in their corner.
No problem. Dan, I've said this many times. I hate IRS penalties. I hate them because most of them are unnecessary.
Yep.
And you can avoid them. It's money thrown away. It's like throwing silver dollars on the floor, as far as I'm concerned.
I don't know how you keep it all straight, but I'm glad you do, and I'm glad you do it with us and for our feds. Folks, that is a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel or Spotify, and please remember to share it with friends, strangers, you name it. Don't forget our live webinars every single week. Just head over to swserve.com. You'll see the webinar button. Click it. The whole menu comes up. Yep, that's right. The guru will come to you, reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all, and share that page with your friends. I guarantee you they will thank you. Be sure to read Ed every single week in the Fed Zone. Again, that's fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, signing off as I always do by saying good luck, Godspeed, and above all, remember, it's your Fed life. You only have one, so make it a great one because you deserve it. Stay well, everybody. We are out.